For today's town hall, we're joined by Matt Hatfield. He is going to be reviewing phase 3.5, which is the new funding of the PPP. We're also going to be talking about strategies for managing any loans your firm may already have received. And then followed by that, we will be talking with Dennis Hall. And Dennis will be outlining some strategies for reopening the businesses. We do know that Governor Ducey has reopened non-essential surgeries effective May 1st. There was definitely some procedures that were attached to that reopening, which I know Diana has been working with extensively with a lot of our medical clients. And I believe he might actually be presenting right now. So we have a little bit of competition between our town hall and possibly Governor Ducey's town hall. But Diana is going to be attending that, and if she learns of anything that he may say about opening up the rest of the states, then she will certainly share that at the end. Please continue to use info@arcwood.com as our Q&A. That's been pretty successful this past week. We'll try to incorporate as many questions as we can into the presentation. However, if not, then we'll just make sure that we follow up and distribute that out to you following the meeting. And again, the meeting is being recorded, so therefore the recording of this will be distributed as well. And then probably just finally, just as another quick disclosure, is that Arcwood Financial, Arcwood Benefits Consulting, and Arcwood HR, we are independent companies, and we do not offer the legal or the tax advice. Our goal is to provide the information to you for assistance in making decisions for you and your companies. We're going to be leaving the legal and the tax work up to those professionals. And so with that, I would like to turn it over to Matt Hatfield from the Lohman Company. He is going to discuss the new funding and then also strategies for managing loans. Can you hear us, Matt?
I can hear you. Can you hear me?
I can hear you perfectly fine. Thank you, sir.
Awesome. Apparently, Governor Ducey didn't get our schedule for these meetings. Otherwise, he would not have scheduled his over ours. So.
Right. Touche. Well played, sir. I appreciate the endorsement.
So I guess another little bit of humor is, as we had our meeting last week, I was kind of kept till the end, and there were apologies made, but my update had changed probably 3 or 4 times during that particular presentation. So I thought by the end of it, I had pretty much the most accurate picture of what the phase 3.5 was going to be. It wasn't correct. It was close, but it wasn't correct. So now that the bill is signed, we now know what we have. And so I think if you advance the slide, I think we have some of the specifics. So phase 3.5, that is officially what they're calling it, because I think they want to reserve phase 4 for something a little bit different and bigger and outside of the Paycheck Protection Program. So they are still calling it the Paycheck Protection Program. That is a part of what was signed in the 3.5 stimulus bill. But basically what they did is they replenished a significant portion of funds to the PPP. The total bill is $484 billion, as you can see, but about $104 billion of that goes to healthcare and healthcare related items that are outside of the scope of this call. I believe that the number now is $310 billion. I have seen multiple sources say 310. I've seen a few say 320. But the big news is the disbursement of the PPP fund starts today. They did something a little bit unique in this round, in that they wanted to reward the smaller banks and really reserve some funds for them to be able to distribute to their theoretically smaller clients. And so what they did is they took $260 billion and gave that to the big banks, if you will, and that's really any bank bigger than $50 billion in net assets. That's what they are. That's what they're referring to as a big bank, and that's going to be your Wells, your Chases, B of A's, all of those, the big boys. But then what they did is they took $30 billion and they said, all right, any bank that has between 10 and 50 billion in assets, we're going to let you distribute $30 billion of the PPP funds. And likewise, they took another $30 billion and they they basically said, all right, anything under 10 billion in assets for a bank, you can distribute $30 billion. So again, what they're really trying to do with that, my opinion, is they're trying to get it down to really some of the small businesses out there and stay away from the bigger businesses that might bank with the bigger companies. One thing is there's a new lender list that was sent out last week, and it was parsed through all over the country. I got one that was actually just for Arizona. Pete, I don't know if you want to jump to that now, or if you want to just we can send that out. It's not a private document. We can definitely send it out. Or in the interest of time, just kind of move forward and just say, oh, there we go. He has it right there. So this just gives you an idea of all of the approved PPP lenders located in Arizona. This doesn't mean this is all of them, but this is really the ones that have significant operations here in Arizona. I still think it would be good to send this out at some point, but you can see they really wanted to broaden the lending base to maybe avoid some of the challenges with the first round.
Yeah, it's also interesting because the way they've divided up this new list is they have the lender status, but they're categorically putting in here alternative lenders, which is going to be your Cabbages, your PayPals, your QuickBooks, Square. So those organizations are now also going to be in the market for distributing the SBA note.
That's exactly right. And I was on the American Express earnings release call on Friday, and they announced that they were, in fact, I don't see it on here, they announced that they are an approved PPP lender, which I was really kind of blown away because that's definitely outside of what their typical business model is. But American Express is now a PPP lender. So
right. And this was, I just pulled this from the local SBA office. So for those of you that are in Arizona, well, actually, I guess for everybody, is I went to the SBA.gov website, and then in their menu items, they had an opportunity to go to a link for local offices. And then once I'm in Arizona, I just drill down into the Phoenix office, hit the Phoenix office's website, and then this is one of the top links that's available to download for the regions. And so for anybody that might be calling from out of state, just go to your local SBA office's website, and then that's where I'm assuming you're going to have this list available to you as well.
Yep. All right. Let's go back to
moving on.
Yep.
All right, that means I got to remember how to do this thing. I mean, Matt and I practiced this earlier for full disclosure, so in theory.
But I threw you a curveball right at the end there, so
that is true.
That was probably my fault. One thing to note, they also included a replenishment of the EIDL loans. That's the Economic Income Disaster Loan. We had been talking for the last couple of weeks that the EIDL loans could be up to $2 million, and then they got limited to $15,000 very quickly because they were getting oversubscribed. They have now replenished that to $60 billion. And again, they segmented it out. There's $50 billion in loans and then $10 billion in grants. And then there is one that the grant is $10,000, which used to be basically you would get the $10,000. But it's now they put into the equation the number of employees, so up to 1,000 employees with the maximum of $10,000. And there's a quirky calculation that if you get an EIDL loan and a PPP loan, you basically roll the $10,000 of your EIDL loan into the forgivable portion of your PPP loan. We don't need to get into details on that, but just know you can do both. You just can't use the funds to do the same thing, whereas PPP is really for payroll, 75% of that, and then rent and some other things, whereas EIDL is really for your overall business, so you can use it for a broader range of applications. Next. All right, so this is one that we want to spend a little bit of time on. There's been some questions. Now that we got our money or we're about ready to get our funding, what the heck do we do? And so, you know, there's certain forgiveness what do you call it? Basically, there's forgiveness portions of this. There you go. Thank you. There's forgiveness criteria. Thank you. Yes, we'll tag team this thing. And in essence, they want you to spend 75% of the funds on payroll, and then 25% on specific overhead, which is really rent or mortgage type related expenses, utilities, that type of thing. And then if you don't use the funds in those ways, there's a reduction calculation that you go through that'll turn it into a 1% interest loan for 24 months with the first 6 months of no payment. So it's basically 18 payments starting 6 months after the loan is dispersed. One thing I want to point out, there's just a really, really fantastic website that I came across. There's the with them down there, the second one listed. There's so much good information. I was walking Pete through this a little bit earlier, and there's really some good calculations on how you go through and walk through your calculation. And so Pete, he's pulling it up right here. And so if you go into that COVID-19 resource center, yeah, I think right there, I think, as it comes up. So I think if you scroll down here, there's going to be right here, these right here, the SBA loans. So there's preparing for your PPP forgiveness. And then there's the actual issuances of the second interim final rule, the initial final rule. But if you go through some of these, and if we can just look at maybe the preparing for the PPP forgiveness, there we go. What I like about this is if you just click, just say that question one, Pete, just go under for example. What I love about what they do is almost any topic that you might have a question on is probably going to come up in an FAQ. And so what they describe for you is what we know, what's unclear in the law. Believe it or not, there are some things that are unclear in this law. And then what their insights are based on what they're hearing and some of their resources. And I'm not here to kind of promote this with them. I honestly don't know much about with them, but I do know their website is very good, and I really like how they laid this out. They really spent a lot of time with it. So I would highly recommend that you just write that website down and spend some significant time going through this website. And it'll probably answer a whole lot of your questions. It'll probably raise a whole lot more questions, as we're going to talk about at the end, because there's some things that keep us up at night. And this website has nailed them pretty clearly as to where some of the big errors in this law are. I'll just give you one example, and it's a little further down. When you talk about the loan forgiveness calculation due to FTE, if you actually do the calculation and your FTE has stayed exactly the same, it's 100% reduction in the amount forgivable. And they just said it's a drafting error. There's no way it can work like that. And so they actually have to change some of these things because of some drafting errors that was never intended to be that way. We don't need to spend a whole lot more time on this, Pete, unless there's anything particular you want to jump on. But I just think that there's a lot of, you can spend 15, 20 minutes going through some of these FAQs, and I can almost guarantee you're going to find many things that are relevant to those who have taken out or are about to take out a PPP loan.
Yeah, I think the only thing that I would probably add is just that the SBA has turned their website back on. So if anybody was looking for information on the PPP or the EIDL loans, say 10 days ago, you would have been landing on pages that effectively said is that appropriations are over and stay tuned to further notice. But now that they have the appropriations reestablished, they have reopened up the SBA's website. And just kind of, clicking into the different sections is that they really have kind of, simplified, I think, the websites as well, where they're giving you a lot more, easy links to details for information. But then just kind of looking back at the information that Matt was just reviewing on the website here, they don't have it a format, which is what we know, what's unclear, and then the insights. And I think that is it's valuable just to have in those conversations when we're talking about kind of how these loans are impacting us. But with that, I can switch it back over to the
That'd be perfect.
PowerPoint.
Yeah, and so going back to what do we do now? We've got the money, so track your expenses. This is so critical for you being able to apply for loan forgiveness. There's some controversy. There's some discussion. How do you track? What's the best way to track your expenses? Some people say, well, just open a separate bank account and put the money in there. You can certainly open a separate bank account, but that's not where it should stop. And you can put the whole loan proceeds in there and then draw on it as you start paying these valid expenses or qualifying expenses, I should say. But what I would do is I would create a separate Excel spreadsheet, and I would log every single what I think is a qualified expense to become forgiven. And then I would update my ratios pretty much every time I make the expense, and really do it ratios as well as dollars. I'd put some targets in there, say I need to make sure I spend this amount in order to get it to get the loan funded. And so I think, again, I'm not going to hold it against anyone if they want to open a separate bank account. I know there's been some advice out there on that. I think even on the State Society of CPAs, a small business accountant recommended that. But that's not going to get you ultimately where you need to be. You can do it, but make sure you track this stuff in Excel spreadsheet, and you can keep all your types of expenses all together in one nice nifty spreadsheet, and update your calculations regularly. Again, a GL account or a separate bank account is not going to really help you do that, but it'll certainly tell you when you're spending the money out of it. But it's just not going to tell you, what your target needs to be. One question we had is when does the clock start as to when you need to start spending these funds? What's the measurement period? Very critical. It is the clock starts for the 8-week measurement period on the day your loan is funded, regardless of where it falls within your payroll schedule, your payable schedule, or anything else. That's really critical. And again, there's one of these FAQs over in that Witham website that says, well, what if my payroll is let's say that 8 weeks ends on a Thursday and my payroll is on Friday. Will I be able to include that payroll? Because obviously you're paying in arrears, typically payroll in arrears. It says it's unclear if it's cash or accrual basis. The way it's written right now is it's written that it's incurred and paid, which that tells me it's cash basis. So I would review your payroll dates, and I'm not telling you to change your pay dates, but I would make sure that you have, an equal amount of payroll recorded, because the last thing you want to do is basically not be able to take that amount into your loan forgiveness calculation just because you missed it by a day, when it really would certainly be valid. So I would say probably start talking to your accounting team right away, or your outside accountant or what have you, and even have them start helping to track these and do those calculations. But and look at your rent dates. Let's say you got it on the 2nd. I guess that'd be 8 weeks out, depending on how the weeks fall. You actually may miss one of those rent payments in there. And that's why I put that down there. The measurement period is 8 weeks, not 2 months. In the bill, they talk about months, and then all of a sudden in the measurement period, they reduce it to 8 weeks. So that was a little bit of a nuance, and actually that's an error in the drafting, because if you do the calculations of loan forgiveness based on weeks, and they use months to calculate what the amount to lend you is, remember the 2.5 times your monthly payroll, you actually can't get to 75% without increasing salaries or some sort of payroll. So if it all stayed the same, it's about a 1 or 1.5 point deficit there. So I don't think they meant to do that, but it is actually the way that the law is written right now. Pete, we can go on to the next one unless you want to add anything on to that.
No, I would just be a witty remark about sausage making. So I don't know if I have anything value to add there. Although, you know what, I could though, because like Kelly and I, she's our CFO. For those of you that haven't met her at Arkwood yet, and we've had the conversations about how we're tracking things. And I think the thing that stood out for me was she's just preparing an audit book. You know, she wants to have a binder because, Matt, correct me if I'm wrong, the forgiveness is actually at the lender level. So this isn't something that we're going to be providing the SBA for forgiveness. The lender is the one who's actually going to be stamping this, correct?
You're absolutely correct. And basically, you're going to go in and apply at the end of the 8 weeks. You're going to apply with your lender for forgiveness. And you're going to basically, give them all of your financial records with all the supporting documentation behind it, and say, here's my forgiveness request. And then they will go through it and do all the calculations as the way they see it and the way they interpret it at that particular time, whatever guidance is out there from the government. And then they're going to audit it. I mean, and there's one of the questions that kind of came up: is this going to be audited? It's like, yeah, well, the bank's going to audit it. The government won't audit it, but the bank is really responsible for making those determinations. So.
Right. So just creating that audit book where you have your summaries in the front and then your supporting details in the appropriate tabs, and, start now, because it'll be easier to make it on the fly than it would be to recreate it.
Exactly right. That's why I like a top-sided, Excel spreadsheet with every single, a log of every single expense with every single, supporting document behind it. So, we have this. We put this together. Pete and I did. Basically, what keeps us up at night, and relation to this program. Well, there's a lot that does, because there's so many. There's so many quirks with it, and so many drafting errors. But we know why, because because it's Congress, and we also know that they were trying to rush something through. But what if the government changes directions on the forgiveness? Could it happen? Anything could happen. I think you would have, a revolution at that point if they say, oh, we're just kidding. We're actually going to make these, low interest, 24-month loans. I don't believe that's going to happen. But there might be certain portions that become unforgivable as they start to clarify some of the drafting errors and some of these, quirkiness things. I really don't think this ever was intended to not make a big portion of these loans forgivable. Because, again, what their overall objective was is to have these companies, these small businesses, come out of this shutdown as strong as they went in. And so to saddle them with a bunch of debt just as they're trying to come out of this recession would be completely self-defeating. And then also they probably had a little bit of bad press on how these loans got out there and to some of the bigger companies, and again, some of the drafting, nuances that made some big companies eligible for some of these loans. So again, no one can see the future, but I think the risk of this, at least in a material amount of it becoming not forgiven, I think is a pretty low risk. Could some? Yes. But do I think a significant amount is? No, I don't think it is. And then right there were the many unanswered questions. I gave you one example of if you just use the calculation on the reduction of FTE or the FTE calculation, it actually, if you just stayed steady, which is what they want you to do, you went into it with 100 FTE and you come out of it with 100 FTE, your forgiveness amount would be reduced by 100%, just because of the way that the document was drafted. We know that's not what they intended, but what are they going to do when they start looking at it and go, oh, we have a big problem? Here's another example. They say right now that the debt forgiveness is not going to be taxable, which is great, right? Because before, for taxability purposes, if someone forgives your debt, you actually have to declare that as like an income and get taxed on that. But what they haven't clarified is, well, you're spending the money, and let's say you have $50,000 of these expenses, and you're spending the money, are they going to allow you to still take those $50,000 as tax-deductible expenses? You didn't pay for them because the government paid for them, but effectively you're going to lose $50,000 of deductions, deductible expenses. I also don't believe that's what they meant to do, but that might be one they go, well, we're paying for it, so let's not allow them to take that as a deduction, whereas you're used to taking that as a valid deduction, a business expense. So there's some of the errors that need to be fixed. How fast will this current round of funding last? And will all the big banks play, I'll say all the banks, but I think it's really the big banks that maybe weren't necessarily playing by the rules, where they were prioritizing certain clients, maybe to shore up their balance sheet risk, meaning if they had a client out there that was a little bit in trouble, they made sure to funnel money in their loan application up front. So when that company gets funded, then they're a better risk, and that bank might have a better opportunity to get paid.
That's speculation for our recording, just for full disclosure.
That's purely speculation that bank did that. I think you're very clear. That's purely speculation. But it was interesting how some banks, processed some significant size loans. And we do know that some people who had their applications in first, and it was supposed to be a first come, first serve, did not get processed first. So how that happened, we don't know. But I think with the parsing it out to the 60 billion, taking it down to the middle and the small size banks in equal proportions, I think is an attempt to get around that. But I still believe that this is probably going to go pretty fast, because I think there's some pretty significant demand out there. The other thing that we don't know is how much of that money that went out there is actually going to come back into the pool, right? That did go out there. Was it 300 million, 300 billion? I don't know how much went out that is coming back into it. We know companies got approved and are not taking delivery of those funds. Pete, did you have something to add on that?
I was I was participating in a webinar that U.S. Chamber did just this last Friday. And there's a gentleman from the Milken Institute. He's a senior director the Senior Director Center for the Regional Economics, and he made a comment that the SBA is analyzing where they feel the need might be better served, and they may be directing assets differently in different regions, which I thought was interesting. Because remember, I think there was I don't know who did the post, but there was something about how Tennessee got X percentage of payroll more than, say, California did, or maybe it was Kentucky, but it was somewhere in the Midwest-ish. And that came up in that town hall that they were having. And I thought that was interesting, that they're also just looking at kind of where the biggest need is. But I don't know how they're going to parcel it down. He just made a blanket statement and then just moved on. I just thought that it was interesting.
That is interesting. I had not heard that. One question that came up says, do we need to show revenue during the 8 weeks? And that's really to see if you were impacted, because there was a certification that says that you need this loan to basically keep your business operating. And I think that's going to be an or underlying question that's always going to be asked. But the answer right now is we don't know. We don't know because there's not a lot of guidance as to what else banks are going to be asking for. We're not right now. You look at the interim final rules. The banks are basically being asked to validate the ratios of what you spent the funds on. It doesn't show anything about, or doesn't say anything about validating the need, validating revenue drops. What about your receivables? And there's a lag, right? I mean, what if you're going along really well and your cash flow isn't really impacted now, but all of a sudden your clients are taking a big old hit, or they're going bankrupt or out of business or whatever else. And so you don't know what's happening to your receivables. So those really are things that are keeping us up at night, is what's going to happen if a company can't show that, hey, in that 8-week period, we really didn't have a problem, but 3 months down the road, there's a big problem. And I do believe, again, that this program was intended to keep these companies in business. And I don't think just for that little short run, but I think for the long run. And so I can't imagine they're going to take a short view of this, but they might. We just don't know.
And we just got a question that popped in, but before you go into the Main Street, we just had a question that came in that says, can you please talk about the CARES retention tax credits? If businesses don't receive or don't apply for a PPP, how can we be taking advantage of those?
I'm going to have to do research on that one. I know a little bit about it, but I don't want to misspeak, and so I'll get an answer to that one, because that is I don't want to speak out of line without having all my facts straight on that one. Fair enough.
And is that something that's different than the the payroll tax forgiveness?
Well, that's what I want to look at, because I think it might be wrapped up into that, and I want to see if there, you know how these things go, right? There's these little things like, oh, there's if you're going down and you think it's that, and like, oh, but there's this little subsection, but I believe it's in the payroll tax forgiveness, which you cannot do both. You cannot take advantage of the delay in funding FICA and what have you, and take the PPP. It's one or the other.
Okay, so we'll
Yep.
I'll get the answer out, and then also we'll just make sure that we cover it on next week's town hall. And then, do you know anything about the Main Street Lending Program?
I do. So it's a unique program, and I think it's up and running. But I know it's actually not part of the CARES Act in and of itself. But it's actually part of the Federal Reserve, and they are using this is what's described as, they're using the discretion given to the Federal Reserve under the CARES Act to basically open this program up. It is really meant for the bigger businesses, not necessarily the Fortune 1000, but it's up to basically 10,000 employees. Companies have up to 10,000 employees, so that would cover small businesses as well. You can have up to $2.5 billion in revenue, so again, a fairly sizable organization. The minimum loan size is $1 million, right? So right there, the PPP is, some of the small businesses won't have that $1 million. And then you must have had in 2019, you must have EBITDA of $250,000 or more. And this is what I want to do a little bit more research on, but basically it says, and no debt. So if you had any debt, and what's debt, right? Is it, if company credit cards are debt, right? Even if you pay them off, you're still, have debt. Is it bonds? Is it, other lending facilities? Is it a line of credit that's open but no borrowings on it? It says, and no debt. So that one almost seems not right to me when I started doing some research on this. But it is certainly out there. It is not forgivable. It looks like it's a 4-year payback, low interest, and again, $1 million minimum size. And again, you have to have certain income requirements, EBITDA requirements for the previous year. It's a little bit outside of what we're doing, but some companies, obviously in that area, can certainly take advantage of this. And it's just getting going. Yep.
And I've got you about a minute left, so I apologize for this before we bring Dennis on. But we did have another question, is that I heard it's okay to add myself to payroll if I wasn't previously being paid as a W-2 employee. Is that correct? And is there a cap on that to pay yourself? So, the cap is the 83.33. Yeah, I'll let you answer that real quick.
Yeah, I'll read real quick. So really good question. So it depends on if you're a Schedule C type person, independent contractor or self-employed person, or if you're a partner or an owner of the corporation. You can, if you're a partner or owner of the corporation, you can put your salary into the forgivable portion up to the $100,000 annualized salary. So if for 8 weeks, it's about $15,385. If you're a Schedule C, you really need to do your 2019 Schedule C, and that will be maxed at that same $15,385 for that 8-week period. But it's maxed at that, and so it can only go up to that, whatever's listed on your Schedule C, line on Schedule C. But that's a really good question. I think there's one in there too that was about bonuses and adding some bonuses to the dollars. Just remember, you're always capped at that $15,385. It's really meant to be ordinary course of compensation. So I'd be careful adding bonuses in there. If they're low dollar, employees, I say what you need to do to keep your business operating. And if that's what you need to do a little bit for some of these, but I would probably assume that it's not forgivable and then maybe get surprised that it is in the end.
Yeah, I've been hearing just for some of the folks that we have that are more in the manufacturing side is that they're pushing up against some competition on the additional $600 a week in unemployment, because it's creating, and Dennis actually might even be going into this too, but just creating the competition for the dollars. And what we've been learning is that if you are increasing your pay, kind of, I guess, as a hazard pay, for lack of a better terminology, that would still be a part of the W-2 wages, and that would still be includable in the forgiveness part when you're doing your calculations of the 75%.
And again, I think that goes under the what you need to do in order to continue your business from operating, and I think that's a pretty good justification. It's like I'm competing with people getting paid more to not work. I think that's
right.
But again, no, they don't say it that way. There's nothing that says it in there, and there's nothing that precludes it. But I would probably, if it was me, I would justify it that way and then fight the bank that way and see what they say. So.
Got it. Thank you, sir. I appreciate your wealth of information.